Okay, hello and welcome to our Yardi Matrix Self-Storage National Outlook on March 8th, 2022. My name is Megan Clay, your producer for today's program. We are joined today by our hosts Jeff Adler and Paul Fiorilla. Our program will run about an hour and we hope you can stay with us for the entire broadcast. Please feel free to submit questions in the Q&A icon at the bottom of your screen throughout the program, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to your situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now, I am pleased to welcome Paul Fiorilla, Editorial Director, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Thank you, Megan, and thank you all for joining us. And I'm all thrilled to have Paul with me today. We've got a lot of ground to cover, and so you see here on the agenda, we're going to cover kind of what's going on in the economic outlook, and then kind of into some specific areas within the self-storage industry, and then also introduce our dedicated RV and boat storage coverage, which we hope we find interesting. So as we always do, let me just kind of get right at it and give you kind of the answers, and then we'll walk through kind of how we got there. The economy does continue to expand, but there are several headwinds that are there, and one could argue might be getting a bit stronger. The supply chain disruptions, very tight labor market, and several other factors. We have an inflation problem. It is not transitory, as we had predicted and expected. The Fed will this month begin a tightening cycle that is a bit overdue. The geopolitical tensions with Russia and the Ukraine add only more inflationary pressures and are leading to declining real wages and incomes, which will slow down economic growth. And even in the past 2 weeks, you'll see that I've taken a bit of a decrease in expected real growth and an increase in expected inflation over the back end of 2022. The storage industry itself continues to perform quite well, driven by the additional demand that was fueled by the pandemic, and we see that growth trailing but still there. Street rates really over the winter did not decline on a sequential basis, continued to increase on a year-over-year basis. Almost all markets showing growth. We are, again, on a sequential basis, you can see that particularly the core cities did have declines, and the other tech hub cities were flat, but that's actually a good sign on a seasonal basis. There's still a lot of new supply, but that pipeline is not accelerating as one would have thought, primarily due to increased costs and inflation in materials and land prices. Investor interest is incredible in the sector, given its performance and defensive nature, which has again proven itself out. So we're optimistic about the storage sector and its performance and profitability and growth prospects, but we do expect growth to moderate. So let's kind of get into where things are at from an economic standpoint. Fourth quarter was great. The GDP estimates coming out of Atlanta, the Atlanta GDP Now metric, which I follow pretty closely, is actually more like zero. And that's really driven by Omicron. But again, if you look at the labor market and job formation, those numbers were kind of incredible. And then we've got some other sort of headwinds. But if you look at GDP on a real basis, it's just about back to trend in terms of the pre-pandemic, and on a nominal basis, obviously it is over trend because we had a very significant uptick in inflation, and that's really the story here. So if you look at these estimates of GDP by quarter, a couple of days ago, I would have had this at real GDP at maybe 4% in the back half of 2022. I've knocked that down to 3%, and I moved the GDP price inflator, which I thought was going to come down to 4%. I pushed that back up to 5%. So that's rather significant inflation. It's way over the 2% of what the Fed would like to see. I do see interest rates supposed to be going up. If you look at where we were in the first quarter, we were already at 2. Now it's 1.7, 1.8. But again, I do think we're on a tightening cycle, but the Fed is way behind the curve on an inflationary standpoint. So if you look at the actual markets, the things that kind of the S&P 500 topped out, we're kind of in correction territory from the top right now. The 10-year was bouncing at 2. It's down to 1.7. It's still, higher than most other places, and we're still got a positively sloped yield curve. But if you see, it is less positively sloped than in the past. So that is throwing off some warning signs about the potential for an inversion. I do think we're on a path toward a recession in 2024, 2025. At the pace we were running at prior to this latest kind of Ukraine and Russia crisis. And so I still think we've got an expansion, but that expansion is in danger of slowing down. Now, if you shift over to inflation, it is way higher, right? 6-7%. The headlines could even be 8 for March on a month-over-month basis. That's a 0.5 point a year or more, and now you're talking 6-7%. And here's the other part of it: is the rent increases from last year, which new rents were up 15% in multifamily. You could argue 12% in storage. That hasn't even made its way into the official statistics yet. And certainly the increase in oil prices that have just happened in the past 2 weeks, that hasn't made its way into inflation as well. So we've got goods inflation to be followed shortly by rent, and a further increase in oil prices and acceleration. Services inflation has kind of taken off. And as mostly you can see in 2021, as people began spending again, they've got cash to spend and a labor shortage. And so off you go with goods and services. There is a geographic component to this, and not surprising, the places that have been growing in population the fastest, where you've had migration, and this is the big story of migration out of the major cities into lower cost cities, because work has become more untethered to location than it has been in the past. People are taking their incomes with them, and these areas, Tampa, Riverside, San Diego, seeing significantly faster inflation than the core cities, Boston, New York, DC. And if you look at the geographic, this is an interesting map of where inflation has been the hottest. So the most sparsely located places, which have had the most people in migration to relative to population, have gotten hit the hardest with inflation. And obviously, in the Southeast, inflation less severe, obviously, in places where there is less demand and fewer people moving into it. Now, as a result of faster increases in costs than wages are increasing, but not at the same rate as costs. You're seeing consumer sentiment begin to fade. And particularly what is relevant is the area that increasing costs the most, which is shelter, energy, and food, right? Affect people of least economic means the most, right? So if you're a homeowner and can work from home, you're shielded from a fair amount of the increases in expenses. But if you're a renter and you have to travel on site, and you have to travel some distance to get to your work, and because of your lower income, food is a greater percentage of your disposable spending, you're going to get hit much worse. So the people at the lower economic strata are going to be hit much harder than those that are further up the economic distribution. And now, in terms of consumption of durable goods and services, you can see as you split it out, there's continued to be expenditures on goods of a significant nature, which has sort of ensnarled the supply chain beyond what it already would have been, and recovery of services is beginning to happen. Change in retail sales, you can see here, building materials, gasoline, non-store merchandise of a meaningful nature. Again, all in the areas that are going to be impacted. Now, I had this title here 2 days ago where we were talking about $90 a barrel, and that was something. Now you're sitting at 128, 129 a barrel this morning. I haven't even been able to update the chart. Do I think that we're probably at the peak of that? Probably. But it's a significant dislocation, and that act as it moves into finished petroleum products, it acts as a direct tax on disposable income. So this also will have an impact on RV and boats. You'll probably see fewer of them out on the road and more in storage because it's going to be a lot more expensive to operate them. Now, if we kind of go here in terms of it had begin to see, if you look at these kind of charts, that you would say that the worst of the supply chain disruptions have been behind us, that they were beginning to work themselves out, that raw material prices had peaked and were beginning to come down, that delivery times were getting better, that ports were beginning to get not so much installed. And I think there is truth to that. That the dislocations in the supply chain for goods probably had peaked, but we have a new set of dislocations and a new set of disruptions that are going to be inflationary in nature. Now, if we go here as it relates to rents, and I use this as a very instructive view in terms of what's happening in the real estate markets. You can kind of see, if I go back to 2007, this is on the multifamily side, right? That wages had been on a nice kind of arc, that rents had been below wage growth until 2015. The overall CPI had been fairly kind of stable. But then take a look at what's happened since COVID, right? You see this big pop in asking rents in 2021. Very much coincident. We'll take a look at multifamily and storage together. But this is the story of the cost of shelter moving up quickly. And even in this case, one could argue, and I have argued, that in fact consumer welfare was being improved because the people at the margin were taking their higher incomes to lower cost cities. Even as rents were going up, welfare this year was improved. However, as rent increases work their way through on the existing installed base of consumer renters, this is where their incomes will bite. Okay. So if we look at the labor markets, a very tight labor market, there is plenty of vacancies, plenty of quits, not a lot of layoffs, more jobs than people. But also we're not responding to that with any kind of change in immigration policy. You can see here the quit rate by industry is the highest at the lowest end of the economic strata. And also we'll see a wage increases highest there as well. Weekly job claims down. So again, a very tight labor market. I think we're at 3.7% unemployment rate. We're at full employment or even kind of past it. So, no need there. If you look at, again, labor demand versus supply, the participation rate, this was the area of concern, has just started to tick up. And I think in February's labor, it was kind of flat. But again, you still have a labor shortage. Eventually gets resolved through automation, eventually. But in the short term, over the next several years, you still, absent any change in immigration policy, of which there's no consensus in the United States, you're going to have a labor short economy. And that also will have implications for staffing for self-storage facilities, and increase the need for automation or the reliance on automation. But also people will have money to spend and they'll need to store stuff. Now, if you look at this in terms of recovery, this is a very deep, very short recovery compared to the GFC, which took a long time to build back. And again, is kind of more ahistoric in the post-war period. And now this is something that is kind of important to kind of just wrap your head around quickly about the labor force participation rate. On the right, you'll see that the labor force participation rate of those 55 and over took a big hit and hasn't really come back. We began to see in January a bit of a pop up, but it's still quite a bit lower, and that's driving a lot of the labor shortage. Even among, prime age, it's within 1% of what it had been before. We still see a labor force participation rate meaningfully lower, and we'll need to coax more people back into the labor market. And I'll go here and also look on an education level. Again, those who are less highly educated have had the steepest decline in labor force participation rate. I thought we'd see a trend that occurred in January, but it kind of fell back in February. And in terms of employees by industry, we're still kind of in hotels, restaurants, and childcare still, quite a bit below pre-COVID levels, which are influencing service levels and all the rest. You can see here, and transportation, housing, retail, these are where the average hourly earnings are growing rapidly, and this is an inflationary sign, which generally has resulted in a tightening cycle that we've seen. But the transportation, warehousing, and retail industries is also where self-storage industry draws its labor force, and so it's going to be under pressure as well. And then as a result, you kind of have an average. Traditionally pre-COVID, we were seeing something like 2.8% compound annual growth rate in average hourly earnings. With inflation of 1.8 and productivity of 1, it was kind of a non-inflationary kind of a way, even at full employment. But kind of the eggs have been scrambled here. So when you back up, and I did want to cover this pretty quickly within about 15 minutes of start here, is where are we at macroeconomic standpoint. The economy is recovering or recovered. Labor market's tight. There's a number of bottlenecks that have occurred in the supply chain, which are inflationary in nature and will take time to work out in autos, in chips, in any number of goods. Demand is strong. There is cash. We are in an inflationary cycle, both driven by the 40% growth in the monetary base, which was to get us out of COVID, but kind of we've got too much of a good thing, as well as industry-specific supply disruptions and a restriction in labor supply, which again has also led to inflation. So a lot of money chasing less goods, a recipe for inflation, and the Fed is starting to increase rates. The clock is ticking to the next recession. My thinking was late 2024, early 2025. The risks to that of being a little bit early have increased, but again, I think we're still in that kind of general time frame. Now, with that kind of backdrop, we started then kind of moving into what's going on in self-storage. So first of all, we break the world out into the major markets and tertiary markets. This is our analytical universe. Our coverage universe is bigger than this, but there's only so many things you can do here. So we'll do here. Now, this is, in my mind, one of the more interesting things to look through is look at the change in rates, pre-COVID to today in multifamily on the left, in self-storage on the right. Now, the first thing we're taking a look is just kind of the 6 core cities. You can kind of see what's happened in multifamily. It's either flat to +10. In self-storage, you still have, let's say, a Boston or a DC that's slightly negative, but the other markets, kind of +10 or so. So a wider divergence by market, but general direction looks about, very similar. Now, when we go to I'll call it the hub, tech hub markets, multifamily had a much stronger kind of 21 kick, but they again same nature of direction. You can see that there was a little bit of a dip in the beginning of the pandemic in these markets, but then kind of taken off. But you also see that the increase in street rents has been in the range of 10 to 20, as opposed to, let's say, really kind of high teens to up to the 30s. Still very, very strong. The difference, I would argue, for self-storage is that more of the street rents are then be able to flow into the installed base, the in-force, resident and tenant base, as opposed to multifamily. And so overall earnings power in self-storage has been higher than multifamily because it's being able to convert that loss to lease into revenue much more quickly. If you look at stock market returns, self-storage has just been amazing. 21 self-storage was the best performing asset type among real estate, outperforming even industrial as well as residential. Shifting here to kind of, we take a look at the REITs that just reported for the fourth quarter compared to how we look at a 10 by 10. You can kind of see the overall realized rent per occupied square foot in the REITs continue to grow. Again, talking about this conversion of asking rents directly into existing customer rent increases. So they've been performed quite well, with occupancy kind of trailing down a little bit, but again, the trade-off on rents being well worth it. When we look at this, just drawn from all the REIT data, when we look at the sort of increase in occupancy across certain markets, you can kind of see recoveries in Portland and Charleston and Raleigh and Tampa and Atlanta. Many of these markets are sort of in migration favorites. I'd say kind of Portland would not be one. That was more of an out migration market. But again, even in Boston, you have a 2.5% increase. So there's a sort of a story to tell that's very similar in nature, I would say, to multifamily, that the migration of persons between markets driven by COVID and the ability to change the nature of work and where office using employment work occurs has benefited self-storage. Now, when we look at this is kind of a national view to look at the trajectory of rents. We're looking here at the 10 by 10 non-climate control. You can see that run up in 2021, very, I'll call it ahistoric, but very similar to the same thing we saw in multifamily, which is really the movement of people. And then a kind of a leveling off, right, nationally to a slight decline in the last couple of months. And then we take a look at the 10 by 10 climate controlled, same general direction. All right. So pre-pandemic, 11.5% overall asking rent change over the period of time, 7% year-over-year growth, less than you have seen in multifamily, and sequentially kind of starting to drift down. Now, when we pick apart, and one of the bigger questions going on was, well, would we see a decline in demand in the gateway markets as those cities began to recover? And there is some truth in that, right? So you can see the tech hub markets, they hit their peak and have largely, kept the gains from the summer peak, which sets them up well for this coming year. Whereas in the gateway markets, there was a decline in rents over the summer and the fall, and then leveled out in December and January, again, which would kind of say that as populations of younger folks returned to the major gateway cities, there was some withdrawal of demand leading to lower prices. And so we're seeing that happen, what we might have expected. Now, as we shift here to talk about our famous bubble charts, I mean, I think the one thing you can take away is just the continued strength in street rent growth kind of across markets. And again, I view this more as the movement of people driving this. And you can kind of see the Southeast, the South, Florida, the Mountain West, all doing quite well in these major markets, regardless of net square foot per person, and regardless of what the pipeline looks like, being able to raise rents. And if you look at these smaller markets, we call tertiary markets, even places like Boise and Reno, right? They have very large square feet per capita, yet and large pipelines. Performance has been kind of amazing. So,
Jeff, real quick
question.
Yeah,
you bet.
Hi,
bet,
everybody.
Jack.
This is Jack.
Jack's our mystery guest. We didn't put him on the agenda, but he's there. What's up, Jack?
Regional preferences and investment options.
Well, my regional, or I'll call it preferences, are really kind of question of where you see populations moving, right, and what the cost of land is, and your ability to garner that demand. So we've seen, just as in other asset types that are sort of consumer in nature, there's been a drifting of, well, you go from kind of, I'll call it international gateway cities to the major tech hubs. You go from the major tech hubs to the satellite cities surrounding those major tech hubs, where housing costs are growing, maybe growing quickly, but housing costs are lower. And there's the movement of people and the spreading of the population. And I would kind of go back to this again, this changing nature of work and where work occurs. The nature of work hasn't changed for people that are not office using employment, right? Warehouses or restaurants or a retail, that the nature of that work hasn't changed at all. What has changed fundamentally is the number of people who no longer have to be in a physical office, and the spreading of that workforce geographically has had all of these ripple effects. So from my perspective, it's more of a question of, well, what's your entry point? What are your return expectations? And Depending upon your return expectations, you may have to go a little further afield than you otherwise would have, or you may have to go to further out. If we follow the single-family built-to-rent trend that's occurred in the multifamily world, that is happening at the fringes of all the major tech hubs, and so I would expect that storage would also, align itself with the movement of people. So that would be some examples, Jack, that I hope is helpful to you.
Yes, you had a couple of quick questions that are relevant to this.
Sure.
One of which is, which industries, and they said hospitality, retail, etc., do you think will be among the hardest hit by next anticipated 2024-2025 recession?
Wow. Well, if you look at the sources, what are going to be the sources of weakness in the economy, right? The tech industry has been quite resilient because it is generally taking costs out of the economy. And also the companies now are fairly well funded. There's always the potential that you've had a lot of speculative money driving some of the VC kind of tech organizations that are making losses opposed to gains. That usually affects. So I think the tech ripple, which used to be concentrated, the volatility would be in San Francisco. I think that volatility will probably be spread out a little further as money gets more expensive, as it will. And if you look at the retail spending, it is just recovering, but I would say the goods sector is probably set for some potential. And there's always the discretionary income on food prep, which will also be kind of hit. And travel's just recovering now. So I think in my mind, if you look at the people who are most likely to be hurt by this kind of inflationary squeeze are going to be those sectors servicing the lower end of the economic strata, because they're the ones that are hurt the most with rising costs and wages that don't keep up. And they're exposed to those increases in costs. So those are the areas that I'd be more concerned about than others. Does that make sense, Jack?
Yes, it does. Thanks so
Okay,
much, Jeff.
you bet. I wanted to sort of to shift here. We've done some work that basically is trying to unpack what's going on with rents. And so just to put a little more color on the overall kind of movement is also looking at, well, you can see here suburban areas have done a bit better than urban areas, and then newer properties have done a bit better than older properties, which would kind of align with people having more income and going to sort of therefore when they're moving, willing to spend a bit more on storage than otherwise. We take a look here about, you can see here also properties that we consider A improvement have done a bit better than others. And when you look at the areas, you can kind of see in that peak that A location and B location did better than C, and that's changed slightly in terms of rates of change, where the C's are picking up some ground. But again, largely this would be consistent with the notion of higher income people driving the moves, having a desire for higher quality storage locations to keep their goods until they kind of finish their relocation, or if they ever do. And when you look therefore also at unit sizes, we also see larger units having done better than smaller, medium-sized units in general, right? Which would also be indicative of a motion of people with income and with stuff, right? Who are moving for, kind of lifestyle reasons and needing more space. So the picture is somewhat consistent. Admittedly, these are sort of unitary kind of slices, but I do think they tell a relatively consistent story. And then we kind of unpack this by market. We just looked at the spread, let's say a 10 by 30, which would be a lot of space compared to a 5 by 5. And I was a little surprised to see, Cleveland having such a big change, but you can kind of see where Jacksonville, has a spread, and some of these other areas have a bit of a spread. So there is some movement across different cities when you look at unit sizes. And then when we kind of go this into here about markets that have done well, we're going to do this on a unit size. These are small units, right? So you can kind of see Boise, 15%, increase in the small units. You also see there's a lot of similarity across across high performing markets. They all kind of move generally the same, but to a greater or lesser degree. You can kind of see there's some big movements here within that overall maybe 7% move. Pretty big movement in certain markets here. Again, tends to be migration favorites with a couple of exceptions. This is where on the medium sizes, which is more your 10 by 10s, and what the spread here is, you can kind of see, was it Boise again, pretty high from 15 to 13. Okay, still a lot. And then you have the larger unit sizes at Jacksonville, Atlanta, Charleston. Again, some of the same markets to a greater or lesser degree. When demand moves, it tends to move together across all unit sizes, again, to a greater or lesser degree. So question then is, okay, well, where do we see street rates going? We know where they've been, where they headed. I would expect that they would continue track the movement of people, right? So if we expect to see the movement of people continue to go into the Southeast, Texas, the Mountain West, but just at a lower rate of change than we saw in 2021, then we would expect to see continued rent growth moderating, because we had that big spike. So if you look at sort of the trend month to month, I would expect year-over-year increases to begin to moderate. I'd be looking closely at this, just as what I'm doing in multifamily and single-family built-to-rent. I'm looking much more closely at the sequential change month to month than I am looking at the year-over-year change, because there's a lot of noise in these sort of, in the first quarter will look like there's big increases, but it will trail down year-over-year in the second and third quarters. But if there's a dislocation in population, self-storage is still one of the best places from an economic standpoint to store your stuff while you're figuring out your world. And so I just think that we continue to see great kind of conditions for the self-storage industry. Any other topics that come up in the chat or Q&A before I kind of move on to some other topics? Paul or Jack?
Yeah. Hi, Jeff.
Hey, Paul.
Glad to be here. There are a handful of questions on different topics. One of them has to do with, you're talking about gateway markets. Do you anticipate that, as offices reopen, that we'll start to see some more demand for storage in gateway markets?
I think the issue is not so much the reopening of the office, but the return of younger populations to those cities more for lifestyle reasons than for that they have to be there for office work. Is they want to be there because of the lifestyle. I think that's the change in calculus that I think is going on here. So I do think there is a return to, and we've already seen it, right? We've already seen a recovery in the rental market and populations, but not necessarily in office opening. So I'm going to bifurcate those things. What that tells me is that we may see a continued softening of demand in the core markets as stuff gets taken out of storage in those locations, because folks who are moving in are going to have far fewer possessions than the folks who are leaving. So I think I'd say, and they also you have a big supply pipeline coming due, let's say in the New York area. So I think those areas will be softened. I think they'll be less strong than places that will continue to get migration net inflows.
There's also a couple questions about SFRs and build to rent. So what is the projected impact of the growth in build to rent?
Yeah.
And one of the questions has to do with the coming SFR foreclosure rate. I'm not sure I see
I don't really see anything happening there.
I don't see that, but just, I guess, address the question of SFRs and how that might impact.
Well, I think what I want to differentiate SFR scattered site from SFR build to rent communities. Okay. So we do cover the single family rental build to rent community world. There's not a lot of product there. We do cover communities over 50 units. There's about 130,000 units in total. There's sufficient capacity and capital to build maybe 30 to 40,000 units a year over the next 5 years. There's already $50 billion committed to that little slice of the world. And I think those areas, that's, if you follow that subclass, you're going to have people who are going to need storage there. And those areas are going to be built out at the fringes of major southeastern and mountain area metropolitan areas. So that I think is a positive one. If you look at SFRs in general, the scattered site world, there's no foreclosure crisis coming there. I don't see that happening there. With home values high, you're not going to see foreclosures. You may see, kind of forced sales, but right now there's a shortage of housing, not much less a surplus. So I think there's an opportunity for storage following those that, again, follow the movement of people is generally the safest thing I can say.
Okay, and then there's also a question about interest rates and the impact on, CRE prices. I don't know if you want to talk about that now or later.
Yeah, why don't we hold off for that one, because that's kind of anything you're talking about CRE prices, it's a question of how fast do rents move, how fast the interest rates move, right? And the flow of funds, right? It really impacts. So we'll have to let's unpack those three when we're a little bit deeper at the end. Fair enough?
Okay.
Okay, cool. All right, then let me kind of go on. Let's just look at some supply trends. So our pipeline, as you know, is broken up into three areas: prospective, where the land's been tied up. Discussion has started with the Planning and Zoning Authority, but no formal plan has been submitted. A plan, when a formal plan has been submitted to the Planning and Zoning Authority, but no building permit has yet been issued. We pick up the date when it is issued, and then when the actual dirt's getting moved and the property is actually under construction. So that's the pipeline. If you look at the sort of completions, I mean, I think what you can take away from this is just the decline in the number of completions that have occurred since 2019. And if we look at the sort of construction period, the construction period has lengthened about 30 days in 2021, versus 2019 or so. And that is a part, but not wholly, of this story. But as demand spiked, the number of completions actually declined, which basically led to a virtuous cycle in performance. But something that kind of bears mention as one of the factors. We do follow abandonments, and it's kind of leveled out, and so it's not really anything special anymore. Yeah, I mean, it seems kind of odd that there were so many abandonments in Albany, but be that as it may, it's more kind of a local set of issues. We do look at the new supply pipeline, and this is a big thing we do cover. And you can see New York is understandable because there's not a lot of supply per capita. It's a big market, and that market is being built out. But Vegas at 16%, absent a world of outmigration from LA, that would have been a warning sign. But given the movement of people, I'm not so sure. It looks to me like that supply actually could be soaked up. You see the same thing in Phoenix or Orlando. These are sort of in migration favorites, Sacramento. So while the pipelines in these areas are a bit large, you also mostly is driven by a movement of population. And then in other markets, the pipelines are kind of more reasonable. Anything under 8, given the construction period of time and lease up, is generally absorbable. And so the only things I worry about are the ones that are big. But when we look at those ones that are big, there's a lot of movement of people. So less of a concern. We do track expansion activity, not just new builds, but expansions as well as conversions. And there is a fair amount of that driven by the land availability next to existing locations, and then also on conversions. I personally was surprised at the amount of that the conversions in 2021 kind of have been so small relative to the years past. But one could argue that that these conversions are coming out of either retail or industrial, and kind of industrial is soaking up a lot of the conversion opportunities for last mile distribution. And so you're seeing conversion play much less of a role than it had in the past in overall additions to supply. And we look at some of the smaller markets. Again, you see some big pipelines on the left side, but if you look at those pipelines, Bridgeport or Connecticut kind of is a bit of a question for me. But Reno or Boise or Tucson, their migration kind of favorites. There are some ones that are a bit large, like Detroit or Baltimore, kind of a bit of an interesting kind of issue to unpack. But many of these kind of do make sense given the flows of population and where they're headed. And we have the same thing. We track the expansions in these markets. There's a fair amount of activity, about 4 million square feet on the expansion side. And a similar fashion, we've also seen conversions decline in these smaller markets as well. Again, probably, driven by the same factor that we talked about in terms of retail and industrial having higher and better uses of that square footage. We did update our delivery forecast, and kind of what some of the takeaways is that it's not all that different than what we would have seen before. The properties under construction have increased a bit, but completion timelines have also stretched out, so that deliveries aren't quite all that different. So this is a good chart we tend to look at quite a bit in terms of, we do see that sort of a little bit of a pop, and then kind of a leveling in deliveries, which kind of keep at a national level things kind of in balance, and not too far out of whack. Now we also, you can see here, we do see that kind of spike in 2023, 24, kind of coming down in 2025. And if you look at overall square footage, that's not a crazy number, kind of across the entire country. Yes, we've sort of said there's big geographic disparities, but nothing seems completely out of whack. Maybe it was 2018 or 2019. There we do track, like, some markets that will not have a lot of supply per capita, that are still, I would say, candidates for a continued expansion. This is mostly of the existing kind of, these areas aren't really growing too much in population, but there's still some opportunity there. And then we have, markets that have high levels of supply per capita, and what they all tend to be is somewhat kind of expansionary markets. Again, Reno and Boise are kind of outliers, but those markets have done incredibly well. So I don't want to read too much into the fact that a high level of square foot per capita isn't necessarily a bad thing, if in fact the population on a relative basis is a heavier user of storage facilities. Again, if we have to kind of recall that storage itself is used by a significant, only a minority, a vast majority, maybe 11, 12% of the population. It is true that we have some data indicating that maybe a third to 40% of movers, particularly on the multifamily side, would use storage. So that's one of the things where we track movement of people as a driver of demand. But it's still a relatively small part of the population, do use storage. So one of the big questions is that we've also been kind of grasping with is, gee, you see this run up in rents, you see a run up in profitability. Why isn't supply responding much more aggressively to the surge in this demand and pricing? And the conversations that we've had really drive down to, well, you know what? It's just cost, quite frankly. We've got 17, 18% increase in expenses. You have increases in lands and land costs. And as a result, deals don't pencil to a greater degree than they had before. And with the data that is transparent, people can see what else is going on. And so they're a little more circumspect about adding supply. And that, as far as I can tell, is why we see supply continuing to be added, but not at an accelerating rate. Okay. And now when we get into transaction activity, because
hey, Jeff,
of,
we have,
yes, sorry.
I'm sorry, we have a bunch of questions, a lot of questions about supply. I just want to
Sure.
I'm going to combine them.
Yeah, sure.
Because, and one of them, it's kind of funny, you were talking about, we were talking about this before the meeting, and
yeah.
One of the questions is the brokerage sector. We are constantly asked what the local square foot per capita ratio is compared to the national average. What is the true national average supply per capita today?
Right. Well, I mean, the average has been about, I think it's drifting toward a little over 7 square feet per capita on an average. That's really based upon about 10-11% of the population using storage, and on average 70 square feet per person. But there's a combination of a 10 by 10 and a 5 by 10, which kind of averages out to 70-ish square feet per user. But what we've seen, right, is that those numbers are kind of rules of thumb. And I don't want to put too much stock into them. They're good points of mental benchmarks, but it's kind of driven by, well, who's moving where and how much stuff have they got, and what percent of the population is in migrating, which would drive what demand actually is, or the need for that demand. So I think those are more the interesting dynamics, is that kind of the movement of people engendered by COVID, and again, this changing nature of work has put a lot more things in play. Does that make sense, Paul?
Yeah.
Okay.
And there's one other question, which I think is a really good question, is, are you seeing an increased demand for development projects in markets with strong population growth? Will this justify higher land bases for storage use types where the highest and best use was otherwise in the past?
Well, I mean, so any place, I mean, by the way, I talked to folks across other asset types, industrial and multifamily, or single family with rent, or in college towns, universities. Land prices in general are up, and particularly where there's been a movement of people. So land prices are up, which then kick off a whole set of cycles as to, well, given the land prices and rising construction costs, what deals make sense. I also can say that because of the performance of all the, I'll call it, consumer facing sectors in real estate, there's a tremendous amount of capital in multifamily, single, the single family built to rent, and in student, and in storage, to deploy capital and to build development arms and development pipelines to capture that. And so, yes, there's competition for land. Storage has always done well when there's like a small parcel left over that can't be used for another asset type, and therefore storage can kind of slide in there and be the highest and best use of that smaller parcel. Because obviously a self-storage facility needs a much smaller kind of slice of land than other uses. Industrial is voracious in its use of land. Multifamily and single family built to rent communities, need at least often 20 acres to make a deal work. A storage facility you can get done in 2 to 3 acres. So it lends itself to sort of that fringe use of land that it can't be used in other ways. So it's a factor everywhere. There's no question about that.
Okay, thanks.
Okay, super. So one of the things we did want to cover, in some of the items we're closing, is just the transaction activity. So you can see just by the sheer number of transactions that transaction activity surged in 2021. There was a tremendous, and the net price per square foot, total transactions are up. And if you look at who's buying, right, institutional investors of all kinds, both the REITs and private investors and new entities, are taking down whole platforms when they are coming to market. So a number of these are organizations. Simply Self Storage bought up by Blackstone. Sparebox was set up by backed by another large organization. None of these organizations have tremendous amounts of capital they're trying to get put to work, and they can only put this capital to work if there's entire platforms being used. Now, as you look at kind of the sellers, well, there's a lot of selling going on and recycling of capital happening, and also will be obviously the actual pure number of transactions will be among the smaller owners. And then this still is an industry that is highly fragmented, that is becoming more institutionally owned, that's becoming more professionally managed, but there's still a tremendous amount of the 80% or so of the assets that are held in small private hands. And then as we this is one thing I've alluded to over the course of our conversation, is this is the data from 2021 in terms of the movement of people. And what do you see? I think highly increases in state, right, where we'd expect the Mountain West, the Southeast, and Texas and Florida, movement of people out of California, New York, Illinois, the Northeast is where people have moved out of. Household formation has spiked, right? You can see here, in 2021, 22, 23, and then we do expect it to kind of come down. Overall housing production is about level with new household formation, but is not eating into the accumulated about 2 million deficit of housing units. And what has traditionally driven demand for storage, death, divorce, dislocation, disaster, is still there, right? But I would say, in addition to that, is this sort of movement of people, and again, I'll go into 3, the dislocation of populations. Yes, there was some decluttering, but I think that's largely already happened. And in terms of business demand, I would say small business formation is another kind of component. If you're talking about a distribution business, first you basically tend to work it out of your garage. You get big enough, you may take a storage facility down, but it's still relatively small driver of overall demand. So again, that decluttering piece here, I think, has already kind of happened. But I would say the biggest driver now is migration, and will continue to be migration kind of next year. So those are the big stories. Now, one thing that came out of, quite frankly, last, I think, summer, I was at the SSA conference. I'm here in Orlando today for the spring SSA. I was at the June SSA, and there was a fairly large discussion about the fact that RV and boat storage, dedicated RV and boat storage, while a sliver of the entire asset base, was a niche that didn't have any coverage, that was very interesting as a land play, and that really needed some coverage. And so we decided to go and do that. And today I'm really pleased to announce that we are introducing, as a subclass within our self-storage data service, dedicated RV and boat storage facilities, over 820 of them in the United States, so across 109 of our markets, over 6,800 acres of land. And we have a kind of basically a fully built out data set. And if you happen to be at SSA over the next couple of days, we'd love to show you. Come on by their booth, and I'd love to talk with you. But that for investors who are interested in that slice of the world, that is now included in our coverage. So pretty hyped up about that. What I would say is, goes here, in terms of upcoming events, we're here in Orlando next couple of days. We'll also be at ISS. And in terms of Matrix, we're also got coverage for student housing and multifamily coming up in April and May. So hopefully, if you found this helpful, you'll also kind of come and join us. So to close, it's much where we started, right? Economy's expanding. There's some headwinds. There's a whole bunch of disruptions. There's a lot of cash. There's inflation. Self-storage did well in a downturn. It's done well in an upturn. It continues to do pretty darn well. There's a lot of investor appetite for getting into it because of its defensive nature and because of the customer base that is, relatively speaking, well-heeled and discretionary, and based upon the movement of people and the ability to raise rents regardless of the direction of what's going on with street rents for new clients. That it's really a great asset type that's performed really well, and we think will continue to do well, but not necessarily at the same pace as it had in the past. So with that, I'll kick it over to Paul and to Jack for any final questions. I am showing you the copyright notice as well as the disclaimer to keep our lawyers happy, because they always ask me to do that. But then I'll kind of go back and again, ask if there's any final questions from the team.
Yeah, we've gotten a lot of questions. Thank everybody for their input. One of the areas that people are asking about is, what is the average lease term these days? Used to be about 14 months. Is that still the case?
Well, we haven't seen big changes as far as I can tell in lease term. We also, we've traditionally seen something like 5 or 6% monthly turnover in units. Now, a big question a while ago before COVID hit was how expensive Google advertising was getting, because there was a big fight over getting demand and having to pay a lot to Google to get it. That, I think, that pressure has mitigated somewhat. But I would also tell you, by the way, it's a shameless plug. I'm doing a panel at SSA on expense pressures, which we'll kind of talk to. But there are expense pressures building in the sector across, you can call it labor, you can call it cost other fees, and other ways to mitigate that. I'd say, we haven't really seen, we thought we'd see big increases in real estate taxes, but we haven't really seen that to the extent, but it's mostly controllable expenses, particularly, it's not just the cost of labor, just the availability of people. Manning a self-storage facility is not necessarily the first thing on people's minds. So there is a bit of a just pure out labor shortage in keeping these facilities open. And what I have heard is that the customer base, just like in other service industries, that employees are exposed to a lot more rude behavior, which is making working on site really difficult. So, other questions, Paul?
Yeah, there's another question. There's a lot, but here there's another question about cap rate compression in the face of rising interest rates.
Right. Okay. So yeah. So maybe we should return to that. So if you think about, again, this question comes up all the time, right? If you want to think about cap rates, right, are a nice, convenient term that really sort of combine several factors. And three of the key factors are the cost of money, and if that's increasing or decreasing, the revenue base, I'll call it NOI base, right? Revenue minus expenses, and where that's going, how fast that's increasing, and then also capital flows. Okay, and truth be told, normally one thinks of, well, if, and this is something we've modeled before, if interest rates go up by 30, 40 basis points, then NOI has to go up 4% in order for that to be balanced off. And so if you look at the trajectory of interest rate increases relative to income increases, you would expect within a year for cap rates to begin to revert, except if there's so much capital coming into a sector that the competition for assets basically mitigates against what normally you would expect to see. Okay, and then that becomes, what is the alternative use of capital, right? And we've seen just an enormous amount of outflow of capital from the office sector, which was the primary sector of investment within commercial real estate. And so much capital has come out of that sector that the capital flows are overwhelming expected cap rate reversions. And so we're likely to see a stabilization in cap rates as opposed to a reversion, at least for the next year or two, because of that particular situation.
And I agree. I think that when we get to, if interest rates go up 70, 100, 75, 100 basis points, I think then we'll start to see pressure. And then I don't know exactly when that might be, but
right.
But definitely the capital flowing into the sector keeps it low.
Yep.
And there's one other, because we're late on time, there's one other question I think that
sure.
we should ask here. If the biggest demand driver of self-storage right now is migration, let's say due to the pandemic, its implications, is it a concern that trending self-storage markets are only transitory if the migration trends start to settle down post-pandemic?
Well, let's kind of go back, kind of pre-pandemic, right? The same markets that were beneficiaries of in-migration, post-pandemic are the same that were pre-pandemic. It was just more of the pace of that migration. So we've seen an acceleration and intensification of migration because of both business opening and the ability, certain places were open for business, certain places were not, in terms of just living your life. And now the movement of people based upon you can keep your income, largely speaking, because of a tight labor market, and move to a lower cost city and improve your overall standard of living. So those trends continue and will just continue at a different pace. It will be to the extent, if you go again, back 2018, 2019, there was so much supply entering those markets that you had a situation of declining street rents, right? Even in the face of that migration, right? So you had so much migration that it overwhelmed the trend toward declining rents, and they actually went the other way. And so as supply continues, again, I call it the cautious optimism, which is, we probably will get into some level of street rate pressure in about 3 years when a recession occurs. because the supply will have finally delivered, and then the migration will kind of be tampered down, and you may be in a situation of declining street rents a couple years hence. Next year or two, I think you still have migration playing out, and the supply hasn't yet caught up. But this is real estate; it's cyclical. The sun doesn't shine forever. So I would say enjoy the next couple years while you can, and understand that yes, I do expect operating fundamentals to soften, coincident with when we would expect to see a recession occur. Anything else, Paul, Megan?
Okay. If we have time, there's one more question that just came in late about
why don't we take
RVs.
one more question before we close? Okay.
Okay. Is there a lack of supply for RVs and boats because of its covered land play nature?
Well, Paul, you happen to write an amazing article. Actually, kudos to Paul here. He actually, I think, releasing a great research piece on this sector, the dedicated RV and boat sector. And if you look at one of the charts that I just love in the paper, it indicates that the biggest area of deliveries in these locations was back almost 15, 20 years ago, and there hasn't been a lot of new deliveries of locations, but there's been a heck of a lot of capital flowed into it, so values have gone up. And so I would say, yeah, there are land plays where you need cheap enough land that that these deals work. And so I do think there's an opportunity here, but you're probably going to have to make sure you're looking at it is most definitely look like a covered land play. And so that's the places that you're going to have to build new facilities are going to be far enough out where the land's cheap enough that that's the highest and best use to sort of park the land until a higher use comes along for that land. And so I think it's going to be much further out, or where it can it can be rezoned. But I'd encourage you to read Paul's piece on RV and boat storage. Great research white paper.
Okay, I think that's it for the questions. Thank you very much.
Okay, Megan, why don't you? We're just over an hour, and why don't you just kind of wrap us up then?
Sounds good. Thank you everyone for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Paul Fiorilla for their commentary today. I would also like to thank Jeff Muth and Mary Chu for running the web program, and Jen Mix and Claire Spadoni for their contributions to the content. This has been a production of the Matrix division of Yardi Systems, Inc., copyright 2022, all rights reserved. This concludes our broadcast. Thank you.
Thank you, everybody.